And I think I saw a buy from an upgrade from Jefferies, but this was, I think, Friday morning. We'll see if there's more there. So, but 25,866 is where the Nifty is trading at. It's about 0.25% higher. The Bank Nifty is actually blinking red and green. So 53,782 is where the Nifty Bank is at. Absolutely flat, nothing at all. The Sensex up 125 points, 84,670. So it's a more measured kind of a start. Though GiftNifty was kind of getting us all a little wild with those with that sort of lure of 150 plus kind of gain. It's not. I mean, it's 70 points to begin the day with, which usually is a better way to start rather than a very exuberant start, and then you spend the rest of the day trying to defend those gains or give in. We've got the heat map on your screen as well. It's mostly all green, just 3 stocks in the red at this point in time. Sribi.
Okay, I'm looking at actually some interesting bounce back on both Vodafone Idea and Indus Towers. Both these stocks are up and about between 4% to 6-7% actually. So pretty interesting recovery after the initial slam dunk when the AGR ruling came through. And also watch for Adani Total Gas, because they've managed to get international loans worth almost, I think, 375 million, if I remember the right numbers, for the expansion of their city gas distribution network. So Adani Total Gas, a stock we haven't discussed so far, that's also up and about. But on the large cap screen, a 100-point move on the Nifty, and leading it from the front would be Mahindra & Mahindra, Bharti Airtel, Divi's, SBI Life, Shriram Finance, HDFC Life. So very diverse set of stocks. First trend being that life insurers, they're having a good start to the session, and M&M is continuing its great form, almost 2% up over there. The banks are actually sitting right in the middle. The Bank Nifty is quiet, flat. SBI, Kotak, it's got some gains around it, about 0.5% up on both of these stocks. HDFC Bank also about 0.5% higher. So it's an easy start for the banks. Let's see if they can build on it. Axis is the one that's not really performing, and ICICI Bank is preventing a wider move on the Bank Nifty. That's the one that's playing spoil sport. And then the other trend for the morning at least is that IT is not participating, not right now. IT is sitting on the fence with a bit of a negative downside. Not a major cut on IT, but let's see. If ICICI Bank decides to move higher and if IT decides to move higher, then who knows, maybe we get to that milestone of 26,000. All
right, well, keep an eye out on a couple of stocks in the broader markets. Fusion Microfinance, the stock is down close to 9%. The street doesn't like the fact that, in fact, they're guiding for asset quality worries going ahead. Just take a look at that. The stock is slammed now. In fact, it's down close to around 9% on very, very large volume. So that's one stock that we're tracking. On the flip side, SBFC Finance, the stock is up close to around 8%. The volumes are massive on that one. The stock is gaining as we speak. Vodafone Idea, the stock is up 6.5%. The opening was around 11 rupees 30 paise. The problem is that there is some panic among those that took the stock at around 11 rupees. Well, there could possibly be some selling. So we'll have to keep an eye out on that stock. ITD Cementation, there is hope. There could be a suitor that comes in, and maybe there's a large one that comes in there. So after the big run that we saw last week, the stock, I think, is making a fresh 52-week high today. And now it's above the price at which the earlier disclosure had come about, when the promoter entity said that they'll probably be looking for a buyer. So I think it's the first time that the stock is trading about that level. If I remember correctly, the stock was around 570 at that point of time, now trading about those levels. HFCL, that's another one that we had good news coming in over the weekend. So that's up close to around 4%. And you have Kochi Shipyard as well. That's up close to around 3%. Fusion Microfinance, though, that's the one that's getting a sharp knock today. Now down close to around 10%.
Well, yeah, absolutely. There is, it was always the cheap microfinance stock, and there's a lot of interest around this at one point in time. But I guess it was and remained cheap for a reason. Of course, getting cheaper now, depending on how you look at it. So that's Fusion for you. 75 points now on the Nifty. We've got 25,870 at this point in time. I think we got I think our market master is with us as well. So we'll just go across to him. Maybe just a quick look at any other names we may want to highlight. Yeah, I mean, we were discussing the telecom names right before start. Idea and Indus Tower, I mean, are the two biggest volume-led gainers right now. And we were sort of talking about this with Mitesh. HFCL, I think we mentioned 4% gain there. SBFC, we did make a mention. Mankind Pharma is up 4%. We'll have the management join us in a little bit from now. There is Share India, which is up about 4%, 333. on that one. VIP Industries, the luggage maker, 5%, 524. But I mean, I can find more names here on the down as I go down the list, but volumes are a little lacking. The big gains last week came through in Reliance Infrastructure. Basically 50% in a month on Reliance Infra. It's the number one volume traded mover, but is down 1.5% this morning. And then you've got these RVNL, IRFC, MGL, PSUs, REITs. I mean, they're all down between 1.5% or so. I was talking about IIFL earlier. IIFL is down about 1.25%. So, I mean, 6-7% move on IIFL, and it's already seeing some profit booking here. So we'll see if there's anything else here. So that's a bunch of names as we start today's Monday morning session. 88 on the Nifty, 25,880. Kenneth Andrade is our market master. He's founder and CEO at Old Bridge Capital Management. Kenneth, great to have you with us here. Thank you very much for your time. Appreciate it. It's been a while. So what do markets do from here, Kenneth? Because, you know, if you flip that question, what will make you negative? Maybe there is perhaps at the margin some valuation concern. But what can cause a significant pullback? And most people struggle to answer. And that is the reason why, although some are waiting on the sidelines, that number is not very large. People want in, especially on the local side. What is your framework of thinking? What the markets do to the end of the year, Kenneth? Go on.
So the concern on valuations, I think, will remain for a while. I've been concerned about it for the last 1 year, but it doesn't really matter because over this period of time, the structure has only gone higher, or the marketplace has only gone higher. And I think the way the broader construct of the marketplace is, most of the negative news is going to come from outside the Indian economy. And that's largely got to do with the fact that I mean, the US by itself is now trading somewhere close to 65% of the world market capitalization. Now, we haven't had that kind of polarization before. India has also had its all-time high, and I think valuations here are close to something we have never seen before. So we are in completely new territory. So I'd be watching out for, or we'd be watching out largely for that. There's no way to time it, but we've been here before. I think this is it's a period of time that that the breadth has to get narrow, and over the course of the next 2 or 3 years, it has to get extremely narrow. So if you work that entire framework out, we've got a positive bias on the economy, but a large part of that is already factored into the marketplace. So I look for international events, how they could play out, and how it plays out on valuations. But largely, valuations have to course correct over a period of time.
Kenneth, hi, good morning. Well, yeah, that valuation debate that's been going on for a while, right? And the market's just been galloping away. But the difference is that there is a bit of a sector churn that's finally happening. Some leadership change. We're seeing the PSUs come off, and we're seeing some money go back into IT, some in banks perhaps. So you tell us, Abhin, what's the approach? Any changes to the portfolio? What's in, what's out, and how are you looking at the next 12 odd months?
Okay, for the largest period of time, as Old Bridge Capital, we've been talking about manufacturing, we've been talking about energy, okay, and a large part of services were not part of that entire framework. I think now, looking in hindsight, if you have to extrapolate the same trends forward, it's going to be a little bit of a challenge because some of these businesses are trading at value at the market capitalizations in a cyclical industry, which some of them don't deserve. Now, I'm not bearish on manufacturing. I think from a GDP standpoint and from a country standpoint, we'll still be one of the fastest growing countries because I don't think, I mean, the momentum that we've already set out will continue into the next couple of years. But here's where we think we need to change the narrative a bit. Okay, we need to find companies that are going to dominate the international landscape. Now, when I say international landscape, IT services has proven the fact that they are large, they are resilient, and they're a mature industry, accounting for close to about 7 to 8% of Indian GDP. Find industries like this, find companies that go out and create an international footprint, and or industries that go out and get an international footprint. And this is without any help from subsidies at the back end. So I think that's how we're looking at our portfolio from say 2024, 25 to 2030. Look for large franchises that are getting built out in the international landscape. Look at market share gains, not just from an India context, but from a context of how these companies will dominate their industries globally. So we got a bias towards services. Okay, and simply put together, these companies have the skill set and have the right to win, if I might say, in the international economy.
Hi, Kenneth. Good morning and good to see you win. Well, what about the alcohol beverage space? That's seeing a fair bit of action, and you've played it in the past via Radico as well as Global Spirits. Now there is this, Andhra policy that could be taking, center stage in the next week or so, as per the new government. What's your view on the theme? Premiumization is coming back. You're seeing more launches as well, and it's an under-penetrated market. Your view?
Okay. I'm not too sure that it's an under-penetrated market anymore because apart from fuel, alcohol remains one of the biggest sources of revenue for the government. Right? That's one part of it all. The second structural thing that we're going through, okay, and this has got to do with beverages and it's got to do with everything else, every other consumer product also, is that if you're going to reverse that per capita income level from say $3,000 to $5,000 and upwards, you will have demand getting created at the top end of the market, and that would penetrate downwards, right? So the premiumization is led by that. The premiumization is led by the fact that that per capita GDP or per capita income is growing at the top end of India, the top end of the population, and which is why you're seeing not just alcohol beverages, but even higher end cars and anything that's got a premium tag to it actually do reasonably well. So that's a trend playing out. I think this is going to go through. It's difficult to grasp as to what how much to pay for some of these businesses, but every incremental growth in revenue or any incremental growth in volume it's got a fairly magnifying effect on the profitability. So if there's a 10% growth in turnover from some of these businesses, the incremental growth in bottom line or in EBITDA could be as high as at 20% to 30%. So that's the operating leverage that premiumization plays out. And I think we're sticking with this cycle for a bit, as at least in the near future, volumes seem to be fairly robust.
Kenneth, just to go back to the earlier point, I was quite curious. You're saying that you're now having a bias for services companies in the portfolio, and that too companies with a large, global ambition and, capable of having a global presence. So what would that be? That would be IT services? I'm trying to think what else fits that description.
Well, you've got IT services for sure. We've got a fairly large exposure to pharmaceuticals and all our product basket out there, all our portfolio basket out there, and virtually 80-90% revenue coming from the international space. Don't rule out businesses like aviation. Okay, so that's how we basically putting it together. So like I said, when in the introduction, valuations at this level are reasonably pricey. Over the course of the next couple of quarters or probably a year, the breadth of the market has to narrow down quite significantly. You've also said this that there is an sector churn. Okay, so you've got to look at individual businesses that are growing into an environment and getting international cash flows, because now you're addressing 100% of the world GDP. Okay, so that's where we tend to look at constructing a portfolio.
Uh, no, got that. Uh, we'll leave it there. Kenneth, appreciate you joining in, and it's a pleasure having you with us. And thank you for your time here on CNBC TV18. I saw a bunch of IT stocks. I'm not sure if I saw some cuts on IT. But the index, it's not doing any. Index actually is in the green, about 0.01% higher at this point in time. Maybe just put up Glenmark, which is shot up to the day's highest point. It started higher, then sold off, but now Glenmark is up 7%, back to the day's highest level at this point. And of course, there is also, Mankind and this one are the two decent gainers which are coming through. The top of the leaderboard remains Idea, Indus Tower, and HFCL at this point.
I just wanted to mention M&M as well, which is the Nifty leader this morning and holding on to that gain of 2%. So no fresh news really over the weekend, but Nimesh points out that there is a favorable Goldman Sachs report, and GS is sounding very optimistic on Mahindra & Mahindra. Their target price is 3,400. And what will take the stock there? They're saying that XUV 700, the more affordable variants of this top seller for M&M, they are going to be supportive of profit growth. Versus M&M's earlier strategy of only focusing at the top end of each of its segments. Now they want to make sure that some of the more affordable variants also come through. And that's where the volume kicker will come in. And then they're expecting, of course, some of the EV launches to work very well for the company as well. So that's M&M. GS thinks the stock is going to 3,400. One more sort of name on the upside today. By the way, while we are talking about M&M, Shriram Finance has dethroned M&M to take leadership position on the Nifty right now. 2% up, big move on this stock. And in terms of financials, it's, again, like I said, it's SBI Life and select banks. So we don't have the roaring bank rally. What we saw on Friday, that's kind of missing. It's a little more measured and a little more mixed today.
Well, that's right. But we'll take green, 150 points higher on the Nifty Bank for now. But from the financial space, Fusion Micro, that's taking a hard knock because the ECL guidance is higher than what the sheet was working with. Vamakshi joins us to fill us in with more on that. Vamakshi.
Well, absolutely, Nigel. A sharp knock coming on Fusion Finance, and that is because the company may be required to make an ECL or estimated credit loss provisioning between 500 to 550 crores in the second quarter is what the company has said. Now, this is much higher as compared to nearly 350 odd crores that we saw in the first quarter of this financial year. In addition to that, the company has said that they have initiated search for a new MD and CEO. They've cited increasing macro complexity as well as the changing sectoral landscape as the reason for the same. They also additionally plan to raise around 550 crores via equity, and this is being done to strengthen the balance sheet for the company. We also have a note coming in from Investec. They've gone ahead and downgraded their rating on this counter to sell and cut their target price to 300 rupees per share. They say that while the microfinance sector as a whole is witnessing stress, Fusion's credit costs are way too high, and given that, they've got a sell rating on this counter. So given that development, especially on the ECL front, we have Fusion Microfinance taking a sharp knock in the trading session today.
All right. Thank you very much for that, Vamakshi, and we'll sort of come back in just a bit for that. Well, I think the InfoEdge management is with us on the program next. Bank of America Securities has made a significant revision to its stance. They've upgraded the stock from underperform to buy, and they've also upped the price target to 9,000 rupees. To discuss this more, we have Chintan Thakur, Chief Financial Officer at InfoEdge, now joining in. Chintan, good morning. Good to have you here. Prashant, this side. Just Chintan, for a name like InfoEdge, when we speak with analysts and ask them, well, what's the best idea to play interest rates in the US coming off? I'll get to individual lines of businesses for you in a bit. InfoEdge gets bandied about quite a bit as a response to that question. I just wanted your thoughts, Chintan, how you think about that big question. It's a big kind of a macro trade. I'm not asking you what the stock will do, but how many of your businesses are actually positively impacted if we are at the cusp of a big sort of cycle where rates come down significantly?
Look, I think from our business standpoint, most of our business, almost all of our business is domestic business. So it is not so much that, the interest rate in US really directly impacts, the domestic business. But what really happens is that, there is a compounding story that InfoEdge has. And if you really look at it over decades, Info Edge has been compounding very strongly. And that's where when the arbitrage between what the prevailing interest rates are and the compounding rate at which the company is growing, that gap actually is of interest to analysts. And that's what kind of creates the buzz around saying when the interest rates are going down, some of the stocks which has a great past trend of of compounding at a higher rate, and that's why there's a lot of enthusiasm about the stock.
Okay, Mr. Tucker, well, that's the overall big macro picture. But let's come down to some of the micros. Now, this note which really caught our attention, where the target price is, I think, 9,000 on the stock. One of the reasons that this particular broking firm or this bank highlighted was that they're expecting Naukri to do very well and start showing sustained improved performance from here on. So tell us what the trends are like. And by the way, one of your peer companies, that's the other piece of news, right? We were also looking at matrimonies getting into the job space. So clearly it's very lucrative. But what is the kind of business growth that you can project for Naukri?
Look, Naukri, if you look at the trajectory, past few quarters, there was a decline happening post the ramp up that happened after the COVID. And then, we have seen steadily it's kind of, getting it at a steady rate, particularly our job market in the IT sector. And we have a almost 50% dependency on the IT sector. So IT sectors was flattened out in Q4 last year, Q1. And now we are kind of now little bit of growth that we have seen past 2 quarters. And then it looks like that we are kind of recovering from there. And that's where we are saying that maybe we have bottomed out of the U-curve recovery. And maybe there are green shoots and we are kind of growing up. This is also further complemented by the commentary that's coming from the IT services company that they are likely to hire more people because their bench is now kind of almost at the bottom. The utilization rates have gone up. So due to some of those trends, it looks like that there is a lot more optimism around how the growth in the job market would be. And it's kind of supported by some of the activities on our platform as well. We publish job spec index, and that also seems to be suggesting that. So that's why there is a bit of more optimism around the Naukri business, and that's our largest business, that's most profitable business. So obviously there is a lot more enthusiasm for the Naukri business. So
sir, some projections will help, some numbers. I mean, even if you can give a rough band for FY 2025, and then if we talk about 26, but for the current fiscal year, what is the kind of top-line growth that Naukri can expect? And also just outline that for the other businesses, for Jeevan Sathi or for 99 Acres. Real estate markets are also booming. Individually, what's the kind of growth that you're expecting all your businesses to fire at?
Look, if I again going by the trends that we have, Naukri has been showing a double-digit or little, around closer to the double-digit kind of a growth in Q1. And we are hopeful that this will improve from here. So from going by that, our real target is to grow at least, in double digits. I would not be able to give you a real forecast of where it would be. A lot of our business for this quarter will happen in last 15 days of the third month. So we would really want to wait for it. But if you go by all the indications that so far we have, external as well as internal, it looks like that there could be a recovery happening, and we are hopeful for that. And that's what gets reflected, in some of the analyst, reports as well.
All right.
Yeah.
Go ahead, sir.
Yeah, the other businesses or even the aggregate top-line number, that would help. I mean, if you can't give individual business projections, then even a top-line revenue projection, that would help.
Yeah, every business had a different kind of trajectory. So 99 Acre, last quarter we have grown about 10%, but it was the focus is more on the efficient growth. Therefore, the growth has been far more efficient, and the profits have kind of, the cash burn has kind of come down. Jeevan Sathi has been growing, at a much higher rate. It has been growing into almost like last quarter was like 35% growth, and that was also more efficient growth. So for all the other businesses, while there's a growth, there is also a lot more emphasis on the efficiency of the growth, and also ensuring that that we are not burning too much cash around there.
All right. Hi, Mr. Tucker. Good morning and good to see you in. This is Nigel on this side. Just to reiterate, you believe that things have bottomed out in the IT space. Recruitment will improve from here on. And for the year, you're guiding for Naukri to grow in double digits. Did we get that correct?
Yeah, I mean, that's what the expectations are, that we should get that trade.
And margins will hold in the mid-50s for Naukri?
Yeah, I think if you look at margin, I think, given that that's very high margin business for us, I don't think that points here and there really matters, but, we are expecting that the margins will grow. The good part of our business is, if I just give a little bit nuance to it, that, the large part of our cost, which impacts the margin is actually payroll cost, it's people cost. And when people cost is going up, what it also means is that there is a kind of a bullishness in the overall hiring market. Right? So if that being the case, we have a natural hedge in that. So if the cost goes up, so is the top line. So and the top line is not so kind of growing faster, the payroll cost is also kind of lower trend.
Okay, got it. All right, let's talk about the smaller segments then. You were targeting break-even in Jeevan Sathi. Does it happen in this fiscal itself? And Shiksha will deliver a profit, right? That's what you're sticking to in terms of a guidance?
Yeah, so there's no formal guidance as such, but that's the expectation that we have built, that, Jeevan Sathi is a business which should get closer to break-even point. Shiksha has been kind of in the range of profit making for the past years as well. So we would think that should continue. But yes, Jeevan Sathi is a business which should kind of get closer to break-even. So is 99-acre business.
Okay, all right. So give us a timeline then of both of them. Because I was going to ask you about 99 acres, since you mentioned the cash burn is reducing over there. Give us a timeline. By the end of this fiscal, both these two businesses, they turn into the black, or are we being a way too optimistic? Will you want to guide for some time in FY26?
Again, I'm not giving a formal guidance, and sometimes we
just an aspiration, sir.
Aspirationally, yes, as I've already kind of said that look, this is what we would want to achieve, and this is what we want our internal team to execute on. But let's see how the market also reacts to it.
So break even for both 99 acres and Jeevan Sathi, hopefully this year itself, right?
Yeah, that's the expectation.
That's the expectation. Sir, just to go back to the point that Prashant started on, the expectations from InfoEdge. So we've discussed all the key businesses in the verticals. The market has a lot of interest in a lot of the investments that you have in Zomato or in PB Fintech as well. Could you tell us what is the aggregate market value? I know it's a notional value right now since you're holding them, but what would be the aggregate value and what's the plan? What's the strategy there? Would you be investing more? Would you look at monetizing at some point in time? There's been some chatter that you might go into an absolutely new, fresh line of business as well. Just some thoughts on the strategy going beyond the key businesses that we've already discussed.
And if I can just add to that, I just looked at year-to-date change for both stocks. I mean, it's remarkable. Both are up exactly 140% from the beginning of January to where they're trading right now. So, I mean, they've turned out to be phenomenal investments. Go on, Mr. Thakkar.
Yeah. So, look, we started investing, almost more than now. It's almost 15 years, right? So, Zomato, Policybazaar, we were the founding investors. And even as on date, we continue to be the largest, shareholder over there. So our strategy has been to go early and keep, doubling down on the investment that seems to be doing well and continue to hold them for a very long period of time. And that strategy seems to be paying off. We have, as we speak, as on this date, many other startups in which we have invested, but they are all very early stage. So it's very hard to really predict, which would be the next, Zomato or Policybazaar in that portfolio. But just to give you an idea, we would have an investment, roughly into 100 plus companies. Right? So that gives you an idea about the number of investments that we have. And some of them, we are definitely hopeful that they would do well for us. So this is now making an investment has almost become like a fifth vertical as a part of our strategy.
No, absolutely.
And we'll continue to do so.
How many of these 100 are IPO ready, sir?
No, I wouldn't, say even, one, although there are one or two small investments that we have which are at the pre-IPO stage. Other than that, I wouldn't really say that they are IPO ready. They are, as I said, that we go very early. And typically for a startup in Indian market, it takes almost like 12 to 15 years for a company to get ready for something like IPO. Unless you are very, very lucky like InfoEdge was, but otherwise, it takes, certainly it's 10 years plus kind of a time period. It's a marathon. So it's a very patient capital that we have invested, and it's we are able to do that because we are investing from our profits. So we are able to
I was exactly coming to that just to get a sense of the future. What is the cash level in the company right now, and what will the allocation plan be? How much as a percentage will you keep investing in some of these newer businesses?
So we do have almost closer to $500 million as our cash on our balance sheet. And even if as I said that we would have this investment as a fifth vertical, this startup by its nature itself does not take so much of money when you go early stage. So there's a kind of a certain percentage only that will go for it. We certainly have cash which is far in excess of what that it is, and that's good for us because we continue to invest in our operating businesses as well. So almost 2/3 of our value creation happens from the operating businesses, and we continue to do so. So there are some defensive reason for which we keep the cash balance. Also, there could be an opportunity for M&A if there's any possibility around that in the operating business side, or even there are some majority investments or minority investments with a path to go to majority, which create more synergies for our operating businesses. We are open to all such ideas, and that's the primary reason why we continue to hold a good amount of cash.
Okay, $500 million. That's that headline stays. $500,000. Yeah, I was wondering. Okay, $500,000.
$500,000. So it's almost like about 4,500.
4,500 crores of cash, right, in the book right now. That's a great war chest to have to invest and to look at M&A opportunities. And we look forward to more announcements and more conversations as and when that happens. Thank you very much for joining in and giving us some more perspective on the business. That's InfoEdge. Have to take a break right now. On the other side, a full-blown discussion on the telecom space. Telecom subscriber numbers have been dipping in the month gone by. So what does that tell us, and what's the projection ahead? Sanjay Kapoor, former CEO of Airtel, will join in to focus on the telecom sector space. Of course, he's an industry veteran and an expert on the subject. Welcome back. You're with us on Corporate Trader. I'm putting the spotlight on the telecom space right now. So two developments. One, of course, the market's still looking at the impact of what the Supreme Court had to say on the AGR curative petition, which it dismissed, didn't offer any relief to those who had filed it, including Vodafone Idea and, of course, Airtel. The second development is the telecom data that came in for the month of July. And a lot of the major telecom operators like Reliance Jio, Bharti Airtel and Vodafone Idea, they've all seen a decline in their customer base. BSNL has, however, emerged victorious because it's had a good month gone by. That's the month of July. To talk about both of these important trends, we have with us Sanjay Kapoor, ex-CEO of Airtel and, of course, an industry veteran. Mr. Kapoor, great to have you on. Thanks for joining in, sir. Good morning. We actually wanted to get you on the AGR news as well, but I think you were busy. So now we have more to discuss with the data also coming through. Let's take the data first, and that's been the big point of discussion and debate, right? That yes, we've had the first hint of a tariff hike come through, but is it being well digested by the market, or is it leading to down trading, disconnections, and basically buying of lower packs, lower data packs by the end consumer? What is your sense? Can the industry push forward more tariff hikes?
First and foremost, a good morning to all of you and all the viewers. My own personal belief is that the subscriber numbers reveal very little of what happens on the ground, and they can be misleading. For me, who's been a part of the industry for many years, and I continue to be one. It is the revenue market share and the profit market share that matters to any operator who's jostling for market share or for supremacy in any market. When you talk about a reduction in subscribers because the prices were corrected upwards, then it could be a reaction to those prices for duality of SIMs before unique customers begin to start making moves from one operator to another operator. So I don't know whether this is just that duality and multiplicity of SIM that has sombered a bit and died down a bit, which actually doesn't matter. As long as for the players who are the leaders in the market, it was unit elastic, which means that despite the subscribers coming down, if their overall revenues grew with the advent of price hike, then I think it was a brilliant move and it should continue. To answer your second question, can the market digest more? Well, we are in a very different era. We are not in an era where telecom was only used for voice or some minimalistic data. It's a service based on which we live our lives, from entertainment to education to investments and what have you. There's lots of things that we end up doing on these devices and with this connectivity through the day, through the weeks, through the months. And for us to be coughing up a little more money, I think is absolutely done, especially if we are looking at quality of service to be internationally benchmarked. Where we are today and where we have to go with the amount of data that gets consumed on mobile and fixed devices, I think we have a lot more to invest in the customer experience. Right. And that can only come if the customers pay for it. I don't expect the governments to be subsidizing or the operators to be subsidizing it from their profitability. If you look at their ROIs, they are amongst the least in the world. They're still single digits, right? So I think there is more room for price hikes, and there should be more price hikes if quality of service has to be sustained.
Absolutely, Mr. Kapoor, thanks for joining us. This question of price increase has also been linked to, over the last couple of years, the health and shape and form in which Vodafone Idea will be around. Now, of course, what is your sense? Because that's, I think, the burning question in the minds of many investors, viewers who are watching this program. After the AGR, the curative petition was declined. What shape and form will Idea be around in? What kind of competition will it offer? And the other question is, how will it be in a position? Are we essentially looking at a very, very weak player? Will it go on lingering for many years? Can something happen here? And what does it mean for Indus Tower as well, which is the tower operator? Go on, sir.
So this is like a Trojan horse question. You have many questions rolled in. Let me first give you a little bit of glimpse of the global scenario. And if you look at any operator, any country across the globe, bulk of the markets had standardized to a oligopoly. And that was the structure that prevailed for last many years, rather a decade or so. But if you look at the technology and the increase in the investment cycles, the third and the fourth operator are finding it tough in any part of the world. It is not unique to India, in any part of the world. And in India, with where we are and the sort of investments that are required to stay competitive, and the edge that the number one and the number two players have gained over the last 5-6 years in the market, and they don't seem to be relenting any space to anybody, I think even if India remains a duopoly, and even if India remains an oligopoly, I think it'll be an oligopoly where the top two players will have 80% market share, and the other two players will really have to strive to fight amongst themselves to say, how do we be in that 20-25% market share space? Now, coming to the AGR bit, I think AGR is a very small thing in the whole schematic. Of course, it matters more to VIL than to Airtel, but it's smaller thing in the schematic, because if you really see the amount of investments that VIL is saying they want to spend on the network alone over the next 3 years, we are still not sure where's that money going to come from, right? And if that money comes and they continue to pay their vendors through equity, will vendors be satisfied with that? Because the equity has been going down, the equity value has been going down. So I guess given the strength of the top two players, given that world over, the third and the fourth player find it very difficult because of smaller balance sheets, and given the fact that this game requires tons of monies to stay contemporary and to contribute to faster capital cycles, I think India, the top two players will have a very large market share, and the balance two players will really have to struggle for a very small market share. And I don't see them relenting any space.
Mr. Kapoor, 30 seconds, not 30 seconds, but maybe in under a minute, if you can outline your thoughts on Indus Tower as well.
Well, the business for towers is all around multiple tenancies. And given the fact that there are multiple tower companies in the country, and Indus Tower is one of the largest one, it very clearly is that, basically there are three players who will give them tenancies going forward. Will they be able to jack the prices up to keep their profitability going? I'm not too sure. But of course, tower companies do well when there's a healthy oligopoly where all four players really compete in the marketplace and have the investment capabilities. When there are only two players in the market, then obviously the tower company loses a little bit of sheen because the tenancies will remain under pressure.
All right, so great perspective. Thank you for joining in, and we look forward to more conversations as we go down the line. Thanks very much for joining us today. Well, that's a perspective coming through on the telecom space, where some of the stocks are bouncing back quite nicely. Let's move on now and put the spotlight on the consumer space. And remember, we've been telling you about the JP Morgan Summit, the conference, investor conference that's underway here in Mumbai. And now we have with us Latika Chopra, Head India Consumer Research at JP Morgan, from the sidelines of the Investor Summit. Latika, great to have you on. Good morning. Thanks for joining in. So I think, you are looking at what right now in the market is once again turning out to be a hot sector, because everyone's talking about whether the rural recovery is for real and whether consumer companies, especially staple companies, whether they can come back with the more promising growth once again. What are your opening thoughts?
Yeah, thank you. Good to be on the show. We started to become positive on the FMCG sector in India, about 5-6 months ago. And there were three reasons, actually. One is, as you talked about, demand narrative started to improve positively. So if you look at the volume growth trajectory for staple companies, it kind of started to stabilize about 2 quarters ago, and it's starting to inch up. And we are seeing, rural particularly catching up, with the urban growth levels. However, we need to wait out to see the durability, the quantum of recovery for the staple packs as far as volume growth is concerned. We are kind of gravitating towards, volume growth levels for most of the FMCG companies to move from flattish to low single-digit levels in the first half of FY25, gravitating more towards mid-single-digit levels. And clearly, upcoming months will be very important. We have so far seen a decent monsoon. We have seen a decent crop sowing data. And we will watch out for how the crop harvest looks like, how the festive sentiment really plays out, to further build up, more on this aspect. But for now, we think this is going to be more a gradual recovery and things to pick up in the second half. The second thing which is going to kind of aid the revenue growth momentum for staples in our view is pricing. This is a piece which was kind of missing for the last 1.5 years. And now we sense, some price increases being initiated in the market. These are still low and probably in the zone of low single digit at the moment. And depending on how inflationary trends really play out, this is another leg which will strengthen and add to the overall revenue growth momentum. And the third piece, which kind of keeps us relatively more positive is that the margins for the sector are largely going to hold out, right? And the good news here is that companies are actually focusing on investing back to drive growth, whether it's in terms of innovation, whether it's in terms of getting the go-to-market right. We think margins are going to see a modest expansion, and that's good till the focus is on top-line driven growth. So net-net, for the sector, we think earnings downgrade cycle is largely behind us, and we hope that we get enough good data points for the sector to start seeing earnings upgrade, in the coming months. So overall, on a relative basis, we like the sector. Yeah.
All right, interesting. Hi, Latika, and good morning, and good to have you on the show. Wishing you all the best for the conference. This is Nigel on this side. Given that there are some green shoots on the rural side of things, and that's encouraging to hear, how are you positioned between discretionary spends as well as staples?
See, at this point, from our strategy perspective, we continue to prefer staples. Rural, if you see, Nigel, has been coming back from a depressed pace, right? And also expectations, I think, on staples have not been humongous in our view, right? As far as urban discretionary demand is concerned, of course, there are different pockets and different nuances to each of the pockets. And then, of course, one is to also look at sector valuations and relative valuations to play. But at this point, we are preferring staples, where we also sense that the relative valuations with respect to the markets are broadly okay. Yeah. I think upcoming festive season will be key to gauge, how discretionary demand really plays out, and there are key sectors like jewelry, paints, durables, which will basically have some, takeaways from how strong the festive season is going to be in the coming quarters. We do sense at present that the urban demand has been more or less stable. Of course, last quarter we had seasonality-led, upticks in some of the sectors like durables, but we will wait and watch.
Right. Latika, hi, morning. Do you have coverage on trend?
No. And
Okay,
we are
right.
not allowed to talk about company-specific
Individual
stocks.
individual companies. Got that. All right. That's been the sort of outsized winner, hasn't it? Just a quick word on QSR, Latika, if you will, as a space. I mean, again, has been beaten down, has not done well over the last couple of years. Are we going to, is the space going to see any traction here? And what's the way to think about this?
Yeah, sure. So I think QSR is definitely an attractive, consumption opportunity from long term. The food services market in India is upwards of $50 billion. If you look at the QSR piece, that's about $5 billion of this. And of course, there are multiple mega trends, young demographics, a consumer who's increasingly seeking convenience, hygiene, experience, and growing urbanization, right? So I think the long term attractive opportunity is quite well established. Of course, in the last few quarters, we have seen comps, the same-store sale comps for this sector being impacted negatively. And I think there are three reasons for this. One is, of course, the macro factors, inflation, value for price, or value positioning kind of getting impacted because of price hikes that players took. The second has been the shift of the category itself to more delivery. And the third bit is that, post-pandemic, we did see a significant acceleration in new store openings, and that kind of, again, weighed down on same-store comps. I think the good news is that, again, here, the players, the key large QSR players, are very, very focused on driving consumer footfall backs, and they're willing to keep margins, give margins less priority versus top line, and we are seeing more and more menu offerings coming on the value side. So if you look into any of the formats, you will find there's a very specific price point advertising that you're seeing, rupees 69, 99, 149, and this is the way to convey to the consumer the value positioning, and this is actually helping drive consumer footfall. So we have seen a sequential improvement in transaction volumes finally playing out for the sector. Of course, the delivery piece is, scaling is coming back strongly first. The second bit is, I think companies have also been quite prudently calibrating their store expansion plans, right? I think we can sense that now from them, and more stores are coming in virgin locations, right? So again, there is lesser, negative effect on same-store sales comps. We think here, the first half of FY25 has likely seen the bottoming of same-store comps, and we are quite hopeful that we are going to see improvement in these comms, in the second half of the year. So yes, this is a space where we are relatively more positive on.
All right, Latika, appreciate you joining in. Wishing you a good conference. We look forward to having a chat with you in the coming weeks as well. Well, let's focus on the next management, Mankind Pharma. That's the next stock on our radar. The company is planning to raise some capital, around 10,000 crore rupees, through an issuance of NCDs as well as commercial papers. In fact, we had a note coming in from brokerage house Investec, and they are very, very positive post the BSV acquisition. Well, let's understand more about how the company sees things shaping up. We're joined by Mr. Rajiv Guneja, the TV18. I wanted to talk about the inorganic growth that you've already announced, but first clear the air. Are you interested in JB Chemicals or not?
We have always said that we are not interested in those entities where our portfolio and their portfolio are same. We've always been lookout for those kind of companies where those companies can add some kind of a value to Mankind's growth, Mankind's products, something which basically help Mankind in acquiring a status in the market that they have highest entry barrier products. That's our kind of a endeavor right now.
Got it, Rajiv. So you're not interested in JB Chemicals. We take that on board. Let's talk about BSV then. You know, some of the brokerages are very, very excited about this acquisition. They believe that the revenue potential by 2032, I'm talking about an Investec note, they believe, that acquisition itself could scale to around $1 billion of revenues with margins in mid 30%. Is that something that you concur with, that, this asset that you've got on your books now can scale up substantially?
So whenever these kind of expectations are raised about Mankind, we take this as a responsibility, actually. And being a very conservative kind of people, it makes us nervous as well, at the same time excited as well. Yes, we are very, very hopeful, and that's one reason we have gone for this entity. This company was in the radar of Mankind since many, many years. In 2019 as well, we wanted to have this company. We lost out to Advent, but sometimes God decides your destiny. We are quite hopeful that now we have got this ride more tacked up, much better. So we hope that, yes, we come to people's expectations. But we are always afraid when a lot of expectations are being raised on Mankind.
Got it. All right.
It really burdens us a lot.
So, Rajiv, going by what you're saying, you're leaning more towards the aspiration is to go ahead and achieve what a brokerage house has laid out. And you're sounding reasonably optimistic as well about getting there, isn't it?
Yeah, I mean, as the entrepreneur, we are supposed to be very, very optimistic. And we have not done it in the past, this kind of a large acquisition. And had not we had this kind of a confidence, we would have never done it. We are very, very bullish, very confident that yes, this is an amazing kind of a acquisition we have done. And we hope that we'll try our level best to come to people's expectations. In the past, we have always believed that Mankind should have some kind of a surprise element. But now people expect more than that. The cat is out and we are supposed to deliver it. We hope that we can do it. It's an amazing entity. It has really added so much of value to Mankind's product range.
Yeah, no, absolutely. Rajiv, hi, good morning. And I dare say we outed the cat because we reported on the story when our colleague Rashna sort of reported on that story. And we'd spoken right after you had announced that deal as well. By the way, congratulations, Rajiv. I think, you are one of the few companies, which has now gotten in the pharma space, which has now got a market cap of over 1 lakh crores. So, I mean, it's been a wealth creation story as well. And I think shareholders should be pretty pleased. Could you talk to us a little bit about the about where this acquisition is at? When do you expect to close the deal? How, is the funding all tied up? What is the structure of the funding? Just some details here.
So this is in a very final kind of a stage. Let's hope very early you'll get the news. You'll come on the same channel and talk to you about this. And as far as the banks are concerned, the funding is concerned, everything is done. And in the past as well, we said that approximately 4,000 crore rupees would come from company side because we have this much of cash. 30% will be QIP, rest would be in the form of debt. That's the kind of a thing we basically feel. That's the situation presently.
All right. Since we have you, Rajiv, very quickly, there were two of those, Western hotels that you were looking at divesting it. By when do we see that? And we are working with a ballpark number of 600 to 700 crores. Is that in the vicinity, or is it better, higher, given the kind of demand we're seeing?
We don't know. I mean, yes, these hotels have been put on the block, and let's see what kind of money they generate for us, so that at the earliest we just get rid of this debt, because in the past we have never ever taken debt. We have always been averse to debt. We have always been cash-rich company. For the first time in our life, we have taken some kind of a debt, honestly.
Okay.
So we would like it to go away from the books of mankind as soon as possible. Yes,
by this fiscal? By this
pardon?
fiscal? By the end of this fiscal, FY25?
What?
Will you be able to divest these hotels by the end of this fiscal?
Let's hope. Let's hope. I mean, we get a right value, and hopefully we'll try to do that.
Okay, Rajiv, so finally, a little shorter conversation today, since you mentioned that, traditionally you've always been debt averse, but right now there is a plan to raise, I think, up to 10,000 crores via a mix of NCDs. You'll look at commercial papers as well. And then there is also the QIP. So just tell us that what is the immediate, the here and now, how much debt are you looking to raise, and how much would be equity capital, and what will be the plan with respect to the debt?
So you see, as a whole, the deal size is approximately 14,000 crore rupees. 4,000 would come from company side, 3,000 would be QIP, and 7,000 would be for some kind of a loan. And let's hope that we just pay back this loan in next 3 years' time. That's the kind of a planning we have got right now.
So we got that, Rajiv. We got the breakup of how you're financing the deal. I meant at a company level, at a sort of overall book level. What is the debt to EBITDA that you are comfortable holding, given that you're doing this acquisition? So you're taking some debt. What will be the debt to equity, and by when would you want to sort of retire and maybe go back to a zero debt situation?
Yeah, I said that in next 3 years' time, we just want to retire all the debt. And at any given time, it should not cross companies' EBITDA to 2 times. That is always a call we have always taken.
Well, Rajiv, always a pleasure having you on the show. Thanks a lot for joining in and giving us all those details. We look forward to having a chat with you, maybe post your Q2 numbers. Well, time to slip into a short break. You come back, we'll focus on the commodity space. Manisha Gupta is waiting for us.
Welcome back. It's time for commodities. Let's find out what's hot. We have Manisha with us. Manisha, so what's catching your eye this Monday morning?
Well, an all-time high for gold is something that we've been talking about. But finally, in the Indian markets as well, we are trading at an all-time high above 74,000 rupees per 10 grams. Well, to begin with, the budget saw a duty cut by nearly 9%. So that really did have a divergent market. But with the kind of run-up that we've seen constantly in the international markets, we are trading at an all-time high for gold globally and for the Indian markets as well. 26.29 as we speak is a new all-time high for the gold prices. 26.25 was the highest closing that we saw on Friday there. So 74,000 when it comes to the Indian prices there. For the last 1 month, we've seen gold prices gain up by 4.5%. In this year until now, the gold is up by 27%. And last 12 months, gold has given you a return of almost 37%, and the gains have just about continued. Gold is headed with these kind of gains for the biggest annual gain since 2010 if you look at the numbers. Also, when you look at the gold prices in last many years, you'll see on how gold has been doubling, almost doubling its returns every 5 years in sense of prices there. I've taken the chart from 2005, that is when the gold prices were at 7,600, by 2010 at 20,000, 24,000 in 2015 and 50,000 in 2020. So from 20,000 to 50,000 in matter of a decade there. And currently we're trading at 74,000 rupees at 10 grams. The markets have seen various supportive factors when it comes to gold. It has been about geopolitical risks in what we've seen in Gaza and Ukraine. It also has been about global central bank buying at record numbers for the last couple of years. The central bank rate cuts has been the latest reason for people to buy gold. And then it's not just about Asia where China and India are buying gold. The Western world is also investing in sense of ETFs and physical gold as well. The gold ETF holdings actually have been looking at net inflows for the last 3 months now, and the net longs on COMEX, that is the speculative markets and the money managers, their net long positions are the highest in 4 years as well. Well, the forecasts have been stronger. That is what the global banks and brokerages have been reiterating. So JP Morgan, Goldman Sachs have talked about 2,600 to 2,700. That is what UBS report also put out. These are the numbers for 2025. We already are trading above 2,600 at this point in time. 3,000 is what Macquarie and Citi have talked about as a possibility in the next year. So even as we've opened Asia on an all-time high for gold, there are further highs coming in.
All right, got it. Thank you very much for that, Manisha. Well, with that, we take a very quick break. On the other side, Lata gets chatting with Puneet Chhatwal, MD and CEO of the Indian Hotels, as the company has crossed the 1 trillion rupee milestone in terms of market capitalization. Stay tuned for that conversation.
Well, who is one of the best beneficiaries of the wealth effect of a stock market hitting new highs, of a burst of conferences due to the IPO mania, or the beneficiary of the K-shaped economic growth that is obvious all over the place? Yes, it is the hotel industry and its kingpin, Indian Hotels Company Limited. Joining me to discuss the rise and rise of Indian hotels and its stock is the Managing Director and CEO, Puneet Chhatwal. Mr. Chhatwal, thank you very much for dropping into our studio at what looks like a very busy season for you.
Indeed it is, and we are really looking forward to the next few quarters, because this is the real test. The base level is high,
yes,
but our spirit is higher, and our production in terms of number of rooms, number of hotels is at the highest. So let's see what the combination does.
That is what I was coming to. Q1 was 6% revenue growth and about 11% profit growth. It was hit by elections. But we were worried about Q2 as well, or at least investors were, because there was G20 a year ago, and then Q3 you had World Cup. So when we got the early numbers for July and August from the hotel industry, it was an eye-opener. It was all double digits. So can you tell us how Q2 may pan out? Is it better than you thought?
When we did the Q1 investor call, I already said that July will be 20% higher than July of last year, because there is a pent-up impact.
In spite of the G20 in the base?
In spite of the G20, number one, there were the wedding dates that moved from Q1 to Q2. Number two, there was no more this, election cooling off period. Number three, the extreme heat had left us. Number four, a lot of business activity, and coupled with a lot of foreign delegations coming into India to, work with the newly elected government, whether they were invited by the government or its business houses coming for business. So I think Q2 is exceptional, but, the way to look at it is Q1 plus Q2 together. Okay. And I think the sector is very well positioned to do well on the first half of this financial year.
Q1 and Q2 together, what kind? Is it double digit? Is it mid double digit? Mid-teens?
I think it should be double digit. Our guidance has been that we'll do double digit growth for this financial year.
Oh, financial year, yes. But I'm coming to Q3 as well, because you will have, or H2, you would have a fair idea of what the bookings are like. In spite of the World Cup in the base, does it look like, it's going to be an easy double digit?
I remain very confident as far as Indian hotels is concerned. I think as far as the sector is concerned, there is nothing that tells us that we should not have growth. Now, whether it's double digit or a very high single digit, that depends on which portfolio you have, what locations you have, what kind of brands you have. So since we operate across the spectrum, from Ginger to absolute luxury with Taj, from homestays to home delivery, I think we are very well hedged, and our not like-for-like growth is very high. We are opening now, as of last month, more than 2 hotels a month. So our guidance of opening anything between 25 to 30 hotels in this financial year stands, okay, and going forward, even marginally higher than that number, because we have more than 100 hotels in pipeline, 112 to be precise.
Okay, so that's about 50% of what is already in operation. So that's
45 okay, to be precise. So
okay. Now, if you have to tell me, where will the growth come from? Will it come from, or what is the percentage coming from new hotels, from increases in tariffs and margins? What would or increases in usage?
Very interesting question. So as we changed the business model, if we looked at the number of hotels, what we had 6-7 years ago, then that would not correspond when somebody tries to understand the top line, because we really delivered on our promise of a balanced portfolio of asset light and asset heavy growth, okay, which was 50-50. Slowly it moves to 40-60. So if we talk about system-wide, is the terminology the hospitality sector uses, or enterprise level revenue, then we would have more than doubled the total revenue. But in this 5-6 year period, if we looked at the consolidated basis, then we have had an increase of 77, 78%. So going forward, I think it will be more or less a similar story because we are not going 100% asset free. We changed the terminology and said it's capital light or capital heavy. Capital light includes operating leases, which is based on a rev share with a landlord. So you don't, capitalize them on the balance sheet. And capital heavy is what you capitalize on the balance sheet. And we believe that that is really the sweet spot, which we have found, and that is making the operating leverage results very high on the capital heavy side, and the margin expansion is coming through the capital light.
Okay, so let me still use the word asset light and asset heavy. You said that you've moved from 50-50 to, probably 40-60 now.
Correct.
What's the goal? Like in 2 years, can it even go to 30-70?
As long as our growth numbers are not, challenged, we want to keep growing at a very strong pace in the Indian subcontinent. And asset light is a good enabler for that. Further, it also helps you to keep growing the margins or keep maintaining those even if there was some kind of sectoral headwinds coming your way. Having said that, one of my key learnings is that if you don't invest in strategic opportunities, in margin enhancing assets, and secure for your brands those key locations and develop destinations in the spirit of Tata Group like we've done over a century, then you lose the competitive advantage. So we would not be having 40 outlets in Goa, including our homestays, had we not been the first one in the 70s to build Fort Aguada. We would not be where we are in Kerala today had we not gone as the first mover in God's own country. Similarly, in Havelock, and as we speak, we are in the final stages of getting the construction permit for the 2 islands in Lakshadweep. So I think these are strategic investments, very strategic business initiatives.
So they will be capital heavy, but...
They will be capital heavy, but will also give you the first mover advantage.
At a later date. Okay, now your margins are about 30%, 28, 29. Now, as you get asset light, do you see the margins, say, in the next 2 years, crossing 30?
Well, we had in our previous strategy, which we communicated, said we'll do 33%. We finished last year at 33.7. So Q1, Q2, if you get close to 30, the likelihood of exceeding 33 is 99% because Q3 is the best quarter and Q4 is the second best quarter. As I mentioned, because of the change in the business model and operating in all segments, I remain fairly confident that no matter what comes, our ability to deliver 33 or higher is very high. And we are very well positioned to do so.
A final question to you, because I'm running out of time. Over the last 5 years, you say you have doubled revenues. How does it look over the next 5 years?
The going is good. Everything looks good. The pipeline is very strong. And
so
we manage our
pipeline
quite well. India looks good. The GDP growth looks good. The disposable income is increasing because per capita income is increasing. India seems to be moving from number 5 to number 3. And the investment of the government in the infrastructure is going to directly benefit our sector. So I think it's a good time to be in the sector. And within the sector, like you said, what did you say, kingpin or something?
Kingpin of the hotel industry.
To be in that leading position.
We would like to think that we are the Taj of the business media industry. Thank you very much.
As long as you use the name Taj, we are very pleased with it.
Okay, thank you. Thank you very much, Mr. Chatwal, for joining here. And considering that they look like they will be able to double in every 5 years, this 1 trillion market cap looks like it's 2 trillion, not very far from here. That's the word coming in from Puneet Chatwal of Indian Hotels. Thank you very much for being here, joining us in this conversation. After a break, time for Chartbusters.